Thanks for joining us today for the results for the quarter and half year ended 30th September 2020. On this call, we will be referring to a presentation that has been shared with you and is also available on our website, and we take as having read the safe harbor statement. From our management team, we have with us Global CEO Shroff, Group CFO Rajendra Darak, COO Diego Casanello, and Global CFO Anand Vora, and other members of the global leadership team. We're also pleased to have with us today Mr. Stephen Dyer. He's the current president at Agrium Retail and sits on the board of UPL Corporation as an independent director. He chairs the audit committee for UPL Corp. We will start the presentation with the business update from Diego, followed by a financial update from Anand. With that, let me hand over to Diego for the business update. Over to you, Diego.
Thanks, Radhika. Good afternoon, everyone. Today I'm pleased to present positive financial results for the second quarter. The last time we spoke, we were still in the early stages of what is an unprecedented global health crisis that continues to affect millions of people around the world. Despite the challenges, our teams have adapted quickly to our new environment to ensure we continue to support farmers in keeping food production uninterrupted. Our hearts and thoughts continue to be with the victims of this terrible pandemic. I am pleased to share that in Q2 we achieved revenue growth of 14% and EBITDA growth of 17%. These results were supported by market share gains in several territories, favorable agronomic conditions, and an improved supply chain from Q1 that was impacted by COVID. The positive developments were partially offset by significant currency volatility in markets like Brazil, Latam, and Africa. We continue to optimize cash flow and reduce net working capital by 14 days, primarily driven by inventory reductions and an extension of accounts payable. As a result of the positive business development, we saw earnings per share improving to 6.07 rupees per share compared to 2.17 in prior year. As we look at the highlights of the quarter, our ability to gain business momentum despite COVID-19 and the impacts of currency weaknesses in key markets demonstrate once again UPL's excellent competitive position and the successful acquisition and integration of Arista Life Science. Volume growth was achieved thanks to revenue synergies from the cross-selling of legacy UPL and legacy Arista portfolios, the continuous growth of leading brands like our herbicide Lifeline, our insecticide Sperto, and our miticide Acramide, as well as more favorable weather patterns in Brazil, US, Chile, and parts of Central Europe. Although most regions have shown an important gross margin improvement, negative currency effects in Brazil impacted our gross margin in the quarter. We continue to increase prices and reduce cost of goods sold. We are confident in our ability to close the gap in the second half. Furthermore, our focus remains on expanding our cost leadership in post-patent product lines, while at the same time making sure that we invest in growing our business with higher value differentiated and sustainable solutions. As we do that, we will continue to drive mix improvements. In the deck, you will find a slide showing the regional performance. We are pleased to announce that all regions have contributed to growth this quarter versus prior year. In Latam, we saw strong growth in Chile, Argentina, and Colombia compared to prior year. Additionally, there was revenue growth in Brazil despite the continued Brazilian real devaluation and supported by pricing improvements over prior quarter. Positive weather conditions in the North American Midwest and better prices for grain commodities led to higher revenues in North America. Dry conditions in Western U.S. increased the demand for miticides. We also saw strong growth in our portfolio with differentiated and sustainable solutions, leading to market share gains in several accounts. We achieved higher sales in Europe despite the second wave of COVID-19. Strong growth in Northern Europe is attributed to herbicides, while Southern Europe experienced growth in Italy and Turkey, driven by fungicides and biosolutions. In the rest of the world, our growth can be credited to the strengthening of our go-to-market in China, including our focus on higher value brands. China is a key market for UPL, and we continue to invest in people and R&D to support our presence in that market. Additionally, new product launches in Vietnam and other Southeast Asian countries are resulting in growth in those countries as well. At the same time, normalization of weather patterns contributed to the strong performance in South Africa and Australia. Finally, India continued to see robust growth in key products, including pre-emergent herbicides and biosolutions. Despite the COVID-19 lockdown, India continued to deliver record collections, which helped our net working capital performance. I want to take this opportunity to say thank you to all our employees for their efforts this quarter and to thank farmers and partners for trusting us with their business. We will move forward into the second half of the year with a sharp focus towards delivering on our commitments and continuing to strengthen UPL's position as a global leader. Thank you very much. I will now turn the call over to you, Anand, to provide more details about Q2 and H1 financial results.
Thank you. Thank you, Diego. Thank you very much. Let me start with the key financial highlights, and then I shall go into the details of the financial numbers. We had an encouraging quarter two with good agronomic conditions and supportive crop prices, as Diego mentioned earlier. We recovered the lost ground in Q2 with revenue growth of 14% and EBITDA growth of 17%, which is reflected in the H1 performance with H1 growth of revenue of 7% and 10% growth in EBITDA on a pro forma basis. The revenues and EBITDA for the quarter were very strong, even though the environment was challenging with currency volatility in some key regions. We are encouraged by our performance this quarter, and Q3 and Q4, which are typically strong quarters for UPL, with peak season for LATAM, US, and Europe, will help us deliver our stated guidance. Moving on to slide 8, which is there in the presentation, the Q2 profit and loss account. Let me take you through some of the key financial numbers in the profit and loss statement. We are comparing the financial results for Q2 financial year 2021 versus the same period in the previous year on a reported basis. I just want to clarify here, when I say reported basis, it is without the impact of the purchase price allocation, which we had to do last year in the same quarter, as it had some impact because of the acquisition of Arista. These are numbers of Q2 compared with the reported numbers of Q2. Revenue was higher by 14% at 8,939 crores. This was mainly driven by 19% higher volume, primarily offset by FX impact of currency devaluation in Latin America. The regional increases in revenues were 12% at LATAM, 9% at North America, 6% at Europe, and 18% in India, and the rest of the world leading at 27% increase. Gross margins were higher by 9%. Gross margin as a percentage of revenue was 40% this quarter against 42% in Q2 last year, a decrease of 210 basis points. The margins were lower due to price pressure in certain regions due to historically low China export prices and negative impact of currency devaluation in Latin America. This has been partially offset by reduction in cost of goods sold, cost synergy, and partial increase in prices in local currencies in some of these LATAM countries. We continue to optimize the fixed costs, and they were flat as compared to that of Q2 of the previous financial year. EBITDA was higher by 17%, which was driven by higher gross profits. Exceptional items for this quarter had to be 211 crores versus 305 crores of the same quarter last year. The exceptional item were mainly on account of $26 million, which is approximately 195 crores, provisioning for the closure of Rotterdam plant for optimization of our global manufacturing facility. This includes certain portion, roughly about 17 million of cash items, and the balance is all non-cash expenses. The production volume for this plant will be made by India and Colombia plant. It will be made up by India and Colombia plant. This initiative is in line with what we had communicated at the time of acquisition, leading to the cost synergies. Net profit for the quarter was 464 crores versus 6 crores last year, resulting in an EPS of rupees 6.07 per share. Moving on to the next slide, which talks about the cost and revenue synergies. The cost synergies in Q2 stood at $33 million, or in INR terms about 245 crores, and the cumulative cost synergies, that's from last year and first half of this year, are at $153 million, against a target of delivering of 200 plus million by end of this financial year, that's 2021. Revenue synergies for Q2 stood at $52 million, in INR terms about 390 crores, and cumulative revenue synergies were $300 million as of 30th September 2020, against the target of delivering 350 million revenue synergies by FY 2022. We remain committed to delivering the targeted cost and revenue synergies. Moving on to next slide, which are the H1 performance. The revenues were higher by 7% and the EBITDA was higher by 10% year on year against the pro forma numbers. When I say the pro forma numbers, they are after adjusting for the purchase price allocation adjustment in the previous year for the same first half. On a reported basis, our EBITDA grew by 23% as compared to that of the same quarter, same half year of the previous year. Gross margins were 109 basis points lower. Recovery in revenues were driven by partial increase in prices in local currency. Net profit was at 1,014 crores versus 452 crores last year. Moving on to working capital, we continue to optimize the working capital and saw a reduction of 14 days over that of the previous year. The inventory for the quarter were lower at 105 days. Receivables were flat at 124 days and payables at 123 days. Payables were higher by 10 days in line with the guidance of increasing payable days as we had said at the beginning of the year. Therefore, the net working capital stood at 106 days as compared to 120 days in the previous year. Moving on to next slide, which is on the cash flow. Cash flow from operations in H1 stood at 136 crores. Cash flow from operating activities were at 3,545 crores. The increase in working capital was in line with the seasonality of the business at 2,915 crores in H1, which, as you know, builds up in Q2 and Q3, and then we have a release in working capital in Q4. Investing activities included a capex of 948 crores and acquisition, of which one of the major ones was Exospec in Chile. Gross debt as on 30th September was at $4.3 billion, $500 million higher compared to March 2020, mainly on account of the bond issuance in June 2020. As we had shared with you, we had done this bond issuance and the basic purpose for this issuance was to buy back the bonds which are maturing in October 2021, which were again of 500 million. We could buy back, we got under the tender offer $81 million of bond. The rest of the money has been retained by us as insurance capital during this pandemic period. The net debt is at 23,841 crores as against 22,060 crores as of 31st March and This is due to increase in working capital. We paid 866 crores of long-term borrowings in H1. In terms of net debt, as on 30th of September, the net debt stood at 3.2 billion. Despite the pandemic, the economy and the business are now getting back to normalcy. After experiencing 2 quarters in the year, we are now more confident to aggressively work towards reduction of gross debt in H2. We remain committed to achieving the 2x net debt to EBITDA by end of FY 2021, that's end of this year, as committed to the rating agencies and maintaining our investment grade credit rating. As for the outlook, we summarize, we believe that the strong volume driven by good weather conditions, new launches, and focus on differentiated products, price increases in local currency, cost savings and synergies, and further optimization of fixed costs would help us to deliver growth in revenue and EBITDA, and we maintain our guidance as we had shared during the last quarter. Before I end the presentation and we move on to the Q&A, I would like to briefly discuss a recent event of the auditor resignation at UPL Corp, the Mauritian subsidiary of UPL Limited. I would like to mention that BSR and Company LLC, which is a sub-licensee of KPMG in India, continues to be our statutory auditor for UPL Limited and for the consolidated financial statements of the group. KPMG Mauritius has resigned as the statutory auditor for UPL Corporation only and have replaced by Crowe ATA Mauritius. As previously communicated, this was done at the request of the company for reorganizing the audit processes and bringing in efficiency in terms of timely completion of audit and announcing the financial results. We have with us Mr. Stephen Dyer, who has also joined us on today's call. He's the Audit Committee Chairman for UPL Corp. So in case if anyone wants to have any specific question, he'll be very pleased to answer some of these questions pertaining to the resignation of the auditor. With this, I would hand over back to Diego for a quick update on our sustainability highlights. Thank you. Over to you, Diego.
Yes, thanks, Anand. In the deck that you can download from the web, you will find a slide that shows our sustainability performance. Sustainability is not a side note for us. It's really at the core of our strategy. It's at the core of our Open Act purpose. And it's really what motivates, all our employees, the leadership, to come to work every day. We are continuing to see our sustainability performance improve each year in the rankings of trusted industry organizations like FTSE Russell, Dow Jones Sustainability Index, and most recently also Sustainalytics. In September of this year, Sustainalytics, an industry leader in ESG ratings and research, ranked UPL number 1 among 53 agrochemical companies, the ones that are under assessment, which are most of them, based on an in-depth analysis of environmental, social, and governance factors. Our score of 26.2 reflects the lowest ESG risk amongst our peer group. This reflects a 38% improvement from our prior assessment. Additionally, we are conducting community initiatives across 10 countries and more than 70 communities, and were recently awarded the Best Community Program Award at the 12th Global CSR Awards and the Good Governance Awards. One of our initiatives that has been announced recently is our collaboration with FIFA Foundation, where 2 organizations have joined forces to promote and raise awareness about sustainability development in agriculture and children education through football. We will continue to focus on becoming a more sustainable organization and achieve our mission to make every single food product more sustainable. We will also clearly communicate our commitments and results over the course of the next quarter earnings calls. Thank you very much, and handing over back to you, Anand.
Thanks, Diego. Thank you very much. With this, we have the senior management team, Mr. Shroff, Diego, myself, Mr. Rajendra Dharak, and Mr. Stephen Dyer, and we'll be happy to take questions. Over to you, operator. Thank you.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Tarang Agarwal from Old Bridge Capital Private Limited. Please go ahead.
Hello, sir. Good evening. Congratulations on great set of numbers. Two questions from my side. One, if I look at your fixed overheads, whether I see Q2 FY21 over Q2 FY20 or H1 FY21 over H1 FY20, they're flat in the ballpark of 3,400 to 3,500 crores for the half year. So, what is resulting in these expenses to be so flat, and how should we see them moving forward? That's one. And the second is any additional non-recurring exceptional items that you foresee going forward in H2?
Yeah, thanks, Tarun, for joining us on this call. I think I would say Q1 and H1 being flat, we make conscious efforts to keep the expenses within a certain ballpark. I would say increase when we do our budgeting. But this year we have been able to keep it, and we also, since this year's budget was prepared, this was the second year of post integration, so we did build in the integration cost savings also, the synergies also as a part of our budgeting expenses, and we made a conscious effort to keep it down. But this year also we were aided by some of most of the world went into a lockdown, and there were significant reduction in travel costs and other costs. Even some of the selling and promotion expenses largely were managed through virtual meetings and other things. So that helped us to keep them flat. Typically, in dollar terms, we make sure that we manage we don't allow increase beyond 2.5% to 3% of in expenses at a global level. So that's our target which we fix. So one could estimate those. Now this would vary from country to country depending upon the local currency and the inflation rates there. But on an overall basis, in dollar terms, we make sure that we try to work within 2.5% to 3% increase year on year and no more. So that's broadly on the expenses.
Sure. And on the non-recurring exceptional cost items?
Yeah. I think we had guided that we would be having close to about 70 to 100 million of exceptional items, which is largely related to the integration. Most of it is over, but one could see another about 15 to 20 million more for the next year. I would say next in H2. The main ones are basically towards the personnel, which, as I said, a fair amount is over. There are some which will be coming through. And the other big one, which was on one of the plant closures, which we have fully provided for in this quarter. So I don't expect more than another, in H2, more than another 30 million if I were to put it additional. And this also is on the very conservative side.
Okay. Thank you. All the best.
Thank you very much, sir.
Thank you. The next question is from the line of Varshit Shah from Emkay Global. Please go ahead.
Hi, sir. Thanks for the opportunity. So my question is firstly on the Latin America. So we have taken price hikes to offset the impact of Forex. How much of that you have achieved till date, and how much more we can see in Q3 coming in, which would aid gross margin expansion? That's my first question. And my second question is on the China strategy. So you have already any update on how the progress is happening on the China side, especially in the B2C and developing brands in China?
Diego?
Yes. Thanks for the question. With respect to Brazil, I have to say that, despite the strong devaluation of the Brazilian real, we were able to increase revenues in Brazil. And that's because obviously we are increasing prices in local currencies. We feel well about our ability to call it normalized US dollar margins when it comes to a fixed impact for over the second half. So that's going to help our margins in the second half. And I would say most of the regions actually are showing better margins already today than last year, which is a very encouraging sign of probably the pricing power of the combined business now of Legacy Arista and Legacy UPL. With respect to China, China is a fantastic growth opportunity for us. It's a big market, and we have now a very important portfolio after the acquisition of Yolo Laoting. We have invested on people on the ground. Recently, more than 15 people to distribute across different territories. We are also moving more towards the B2C model, where we are creating demand and helping our distribution partners pull, let's say, the business in the key crops. We have been, traditionally, the Legacy Arista was having emphasis on more on the specialty crop market and on the seed treatment market. And with Legacy UPL, we had a fair position in the row crop market and some additional products on the specialty crop market. So now we have a complete, a very vast coverage of the Chinese market. But we are just at the beginning. We believe that we have a great opportunity in China to make China in the future one of the biggest countries for UPL.
So thanks. And just one last bookkeeping. Can you repeat the net debt figure once again?
Sorry. Can you repeat the question?
Yeah. Can you repeat the net debt numbers once again in the first?
Yeah. Net debt. I'll give you those numbers.
Sure.
Yeah. The net debt. One minute.
And then you need to go on mute. There is disturbance.
Yeah. The net debt is 23,841 crores as of 30th of September.
Okay. Sure. I'll get back in the queue.
Thank you. The next question is from the line of Ritesh Gupta from Ambit Capital. Please go ahead.
Hi guys, congrats on good set of numbers. Just two questions from my side. One is the plant that you're closing, what does it make? Is it the Notre Dame plant, did you say? I mean, did I hear it correctly? And then on the second bit, hello?
Yeah, go ahead.
And then on the gross margin side, we have still seen, last year the margin was reasonably weak. And this time we have seen, this time also the gross margin hasn't been that great. So should we assume that this is there is a 100 basis of margin improvement on a 1H basis? But I would understand that last year the margins were impacted due to weaker geography, mix, etc. So this time only a 100 basis of margin expansion on a 1H basis. Is this a normalized level, or should we expect an improvement at some point in time?
So go ahead, Diego. Yeah.
Yeah, no, I mean on the Rotterdam plant, the technology that we were producing in that plant, we are producing in other two plants. So this is merely an optimization opportunity to consolidate and be more cost efficient on that product. I mean that product is actually growing nicely, but we have sufficient capacity to do that. And on the margin, I see margin expansion opportunities. I think the impact that we have seen was due to the devaluation of currencies in Brazil, Mexico, Colombia, some countries in Africa. We have seen significant devaluation with the COVID crisis. But historically, if you look at margins in this industry after events like that, you see that there is a lag, but then there is a phase of recovery, and we are seeing also the trends in that direction. So we are confident towards our ability to margin the next quarters. You always have to look at the quarter also from a quarter-to-quarter perspective, because this is a seasonal business and the portfolio mix changes. But when you compare last year's quarter to this year's quarter, our expectation is to see an improvement in the coming 2 quarters.
Got it. So
just to add further from what Diego mentioned, I think last year when you're comparing, we did mention to you that last year both Europe and US regions had weather-related issues. This year the agronomic conditions are very good, and we expect Europe and US to also bounce back. And as you are aware, these are profitable markets. So one should expect, I don't think this is the new normal. One should expect a good margin improvement, as Diego mentioned, over the next 2 quarters also.
Because what I'm surprised with is that why you actually have 200 basis of decline. I'm just looking at your presentation, which is CP adjusted. So despite that, there is a 200 basis of margin decline on a YY basis, which ideally, like if you have seen a decent revenue growth and this thing, so is it largely exchange-led? You would attribute it to the extent that it has also eaten up some of the product mix improvement, or I think last year glufosinate was also under pricing pressure. So
it's largely to exchange rate, Ritesh. You're right. We saw sharp decline in some of the LATAM countries' exchange rates, and that you can't increase the prices by 30-35%. When you have a sudden drop in the exchange rate. So it was largely because of that.
Got it. And if you could just highlight the amount of cash that is there on the books, and I think it's decent to elaborate on some bit. Why the company continues to keep such high cash on the books?
I think it was because of the pandemic, and I think we have already initiated the process. As I mentioned in my opening statement, we have reduced our debt at a gross level by about 700-800 crores, and we will continue to do that aggressively over 2 quarters. We have mentioned we have, I think world has learned to live with this pandemic. Businesses are returning back to normalcy. Banks are more than happy to lend money. So we are working on a plan to bring down our cost debt as we move forward.
Sure. Thanks so much. Thanks for taking my question.
Thanks for joining us.
Thank you. The next question is from the line of Ayan from Invesco. Please go ahead.
Thanks very much. I just wanted to ask Mr. Dyer, the audit chairman of UPL Corp, maybe just to share some of the experiences that UPL Corp has had in completing the financial statements on time, and just some insight into the decision-making process to move the auditor back to Crowe, and also your confidence in the resources that Crowe has to provide to UPL.
Sure. Yeah, sure. It's Steve Dyer here. And in terms of, I'll talk about the change in the auditors first. So just, again, a little bit of a background that I'm sure that's already been communicated is it was about a year ago that change was made to KPMG originally, and Crowe was doing the audits before then. And that was really done from a consolidation standpoint. As mentioned, KPMG is doing the audits at the limited and consolidated level. So from an efficiency standpoint, thought it made sense for KPMG to do the Mauritius audit, make that change at that time. And then after going through a few quarters, it was clear that KPMG was struggling to complete the audits on a timely fashion. There was no concerns around the quality of the information being provided, but it was creating both stress in KPMG and within UPL. So after discussions with KPMG, it was really a mutual decision for them to step down from that audit and move back to Crowe. So as mentioned, Crowe was doing that audit previously, and so again, no concerns from that standpoint. We actually had our first audit this last quarter with them. We had both KPMG and Crowe at the table with the audit committee, and that transition back to Crowe went very smoothly. So from that standpoint, no concerns from going forward with Crowe, and then the audit committee will continue to have access to both Crowe and KPMG, as on an as-needed basis as well. Just overall, the comment I would make is, having worked at Agrium, now Nutrien, that was a very acquisitive company. One of the challenges is doing a large merger, which the UPL has been going through over the last year. And having gone through many of those myself at the corporate level, I've been very impressed with the ability for UPL to bring the two organizations together, drive the efficiencies, but as well as implement the systems within the two organizations and bring that together. So I think that's been a very strong point of UPL, to bring two organizations together, drive those efficiencies, get their SAP corporate accounting system in place across the entities, which brings a lot of good controls in place with that and consistency across the organization. So so again, change that was made, again, no concerns going forward from my standpoint as the audit committee chair of UPL.
Thanks very much for the insights.
Thanks, Ian, for joining.
Thank you. The next question is from the line of Rahul Vora from Abacus AMC. Please go ahead.
Hi, Anand sir. Just wanted to understand if you could throw some light on the supply chain going ahead, since our Rotterdam plant will be what kind of molecules.
Sorry to interrupt. Rahul, we are not able to hear you properly.
Hello?
Yes, sir, your voice is breaking up.
Okay, can you hear me now?
Yeah, go ahead. Go ahead.
Anand sir, we just wanted to wanted some highlights on the supply chains going ahead. After our Rotterdam plant shut down, what are we planning from where we were planning the molecules earlier there? How are we planning for the supply chain going ahead? And logistically, would it still make sense to supply from India?
I'm getting fast. Yeah, go ahead, Diego, please. Go ahead.
Yes. So we will be. Sorry, Jay, you want to say something?
Sorry, Jay, you want to go ahead? Go ahead, please.
Yeah. So as UPL is, we've just gone through a large expansion of our facility in Colombia, and we are looking at rationalizing our manufacturing as an integrated new UPL, and this is just part of that. Obviously, we will not. We'll make sure we don't lose any market share anywhere, and we continue to be focused on our manufacturing cost. We believe that we have an excellent manufacturing platform, and we can aggregate that and remove necessary costs and rationalize all the facilities to really integrate the whole business properly. So this is an ongoing thing which we were working on for a while. Diego, go ahead.
Yeah. No, I think that summarizes, Jay. We're always looking at how can we, cement our cost leadership, right, and be efficient in our supply chains, and this is one of those steps.
Sure, fair point. So just an additional question in the same context. I wanted to know if these molecules which you are producing in this facility, will they be produced in-house or will it be outsourcing to some other company in India itself?
We will be.
Go ahead, Jay. Go ahead.
These are in-house facilities. This will be rationalized into an in-house facility.
Okay. Fair point, sir. Thank you.
Thanks, Rahul.
Thank you. The next question is from the line of Abhijit Akela from IIFL. Please go ahead.
Yes, sir. Good evening. Thank you so much for taking my questions. First question is for Diego, actually. There are news reports about a possible phase-out of mancozeb in Europe that the regulators there have arrived at. So, would appreciate your perspective on what the timeline for this might be, and how de-risked UPL is with regard to mancozeb in Europe. Thanks.
So, we are awaiting an official position from the European Commission. We are working on this since many years now. We are prepared for any eventualities. For obviously, if Mancozeb remains in Europe, great. If not, we have plans to replace Mancozeb with other products. But let's say overall, we believe that we have very strong arguments for defending the molecule in Europe and in other parts of the world. But Europe has a very very particular approach towards the approval of crop protection products, and we know that sometimes it doesn't follow the same scientific approach that maybe some other regions follow. So we are conscious of that, and we are discussing with the authorities and waiting for being a final position or a final communication with regard to Mancozeb. So we'll keep you updated, obviously, as soon as there is an official communication.
Great, thank you. And my second question is, with regard to the recent increase in crop prices that we've seen across the globe. Particularly in the last 3 months, we've seen sharp increases in prices of corn, soybeans, wheat, and maybe several other crops as well. Plus, there is talk about La Nina impact on crop production and droughts in various parts of the world. So, would appreciate your perspective on how it might impact UPL's business in the short term, because of all these droughts and disruptions, as well as maybe over the medium term, let's say the next year, if these prices sustain at these levels. Thanks.
Yeah, so obviously we are a global company, and always we are facing here and there some drought events. The business is very well fragmented and very well diversified, so that we are able to sustain cash flow performance despite this. If you think about last year, for example, it was an extreme year with respect to the events that we saw. But we are very, very largely diversified, and we have technologies that somehow, when you have a dry period like we saw, for example, in the west of the U.S. this year, our insecticide business tends to be stronger, while our herbicide business tends to reduce. But there is a certain offset, let's say, also from a technology standpoint. Overall, obviously, we like rain. Just to make it very clear, we like rain, but we feel like our business is robust. We're also working on technologies to help farmers reduce the use of water for irrigation, for example. So and also sustain dry periods in a more strong, robust way. For example, our biostimulant product line that is growing significantly is helping farmers go through stress periods or crop stress periods better. So we obviously like to have good agronomic conditions, but overall our business is robust, and this is nothing new in a way, right? We have seen these cycles all over in the past too.
Yeah, just to add to what the other saying, UPL with the price increases, we expect that our whole sustainable and our biosolutions yield enhancement products will see a good uptake in the next not only next half, but even going forward. Future prices also look good, and the farmers are selling their crops into 22 season already. So we are seeing a positive outlook even going forward to 22, at least in some of the markets where farmers sell advance. So we are excited about our portfolio to be able to balance this whole thing out.
Great. Thank you very much, and wish you all the best.
Thanks, Abhijit. Thanks for joining us.
Thank you. The next question is from the line of Wei-Ling Cheng from Credit Suisse Asset Management. Please go ahead.
Hi. Thank you for the presentation. Just two questions from me. One is for India, I think the government has passed out the agricultural bill that reorganizes the way farmers transact businesses. Just wanted to have your share of how do you see that impacting your business?
Sir, we are not able
Just
to
one.
hear you clearly.
Sorry?
Mr. Cheng, your voice is not clear.
Oh, okay. Can you hear me now?
A little better, sir.
Hello?
Please go ahead.
Yeah,
Hi. Just wanted the agricultural bill impact on your business. Do you see any change there? That's number one. Number two is you talked about maintaining IG ratings and debt reduction. I just wanted to have a sense of what are your strategy for this? As in, is there a particular number and timing that you target for debt reduction?
I can take the first one. As far as any kind of transition in large market like India will cause some disruption, right? Overall, the government is trying to make it easier for farmers to sell without restrictions. Short term, these could cause some disruption, but long term, companies can sign contracts directly with farmers, and this is going to help. Short term and medium term, I believe that some value chains will have some disruption. But in the long term, these all actions will really help to help agriculture, the whole food system become more resilient. Anand, you can take it.
Yeah, I'll take the second. So on the net debt, our commitment to the rating agencies has been that we will be ending the year as of 31st March with net debt to EBITDA of 2, around the 2 levels, which would mean that about we will reduce our debt by about 700 to roughly anywhere between 700 to 750 million dollars. So that's our target between now and 31st March.
Okay, thank you.
Thank you.
Thank you. The next question is from the line of Neha Manpuria from JP Morgan. Please go ahead.
Thank you for taking my question. My first question is on Latin America. Yes, I think in the last call you mentioned there was shift of buying from the first quarter to second quarter, and I think potentially even to the December quarter. Is that still valid, or you're still seeing, or potentially we could still see some sales slip into the December quarter, which was supposed to book for this quarter?
So, we see, we have seen indeed, if you remember the first quarter, we talk about the first quarter being slow, and that holds true. I mean, volumes were significantly up in the second quarter, and we see these trends progressively increasing. I think the second half in LATAM is going to be stronger with respect to the volumes and also with better pricing overall compared to the first half. The reason being that if you think about it from the perspective of a farmer today in Brazil, soy prices are as high as in the last 3 years, right? So it's really very good soybean prices. You see also very good corn prices actually also in LATAM, and with the depreciated currency like they have, what happens is that the farmer incomes are expected to be much more favorable. So that is favoring the investment in technology, the investment in buying inputs. So together with, I would say, good agronomic conditions, I mean, we have had a little bit of a delay of the planting in the south of Brazil. That might impact a bit the use of some fungicides. But overall, we believe that the season is unfolding better in the second half than last year.
Yeah, that was my second question.
Currency volatility. The currency volatility is something to watch, right? I mean, we are assuming a real at the levels that we have seen over the last months. That's the thing to watch. But assuming we continue to see these levels, we are confident about the second half.
Thank you. That is my second question, actually. Newspaper reports mentioning that, soybean crop in Brazil is, I think, at 25% levels versus the usual 65-70% levels at this time of the year because of dry weather. Is that concerning when it comes to our inventory position, and particularly sales into next year, or do you think it's still very early to call that out?
It's not something that worries us much in UPL because we are less exposed to the, call it large Asian rust fungicide business in Brazil, which when you have this shorter seasons in soybeans, that tend to be affected a bit. The good news is that actually we're bringing products starting late this year and next year, so we will be actually participating big in that market in the future. But for this year, I think we are not as exposed to this impact, and overall herbicide consumption will be good, and we believe also the insecticide season will unfold very strong.
Understood. I had a second question, but I sort of have messed up. No worries. Thank you so much.
Thank you.
Thank you. We'll move on to the next question. That is from the line of Prashant Biyani from Prabhudas Lilladher Private Limited. Please go ahead.
Yeah, thanks for the opportunity. Just continuing with the previous question, we have been hearing news of quite robust crop prices globally, especially in Brazil, and agriculture activities good in Europe and North America as well. Plus, glufosinate and mancozeb prices are also up by around 40% and 20% respectively. So in that backdrop, don't you think that we can beat our full-year EBITDA growth guidance of 10 to 12%, or there is something which can offset those benefits?
So I'm not sure if acoustically I heard well the question, but we are confirming our guidance for the year, right, and our outlook for the year, and that's thanks to also on the back of a strong season in Latam. So we are confident. We're cautiously confident that that there are good tailwinds that will help our business in the second half in that area.
No, I meant our guidance isn't it a bit conservative given our decent first half performance as well?
Well, we generally don't change guidance during the year. So I think when we started off, it was supposed to be aggressive. Yes, after the first half numbers, it's looking easy, but we generally don't change guidance during the year. So, let's hope for the best.
Okay.
Yeah. I think with there is a lot of volatility, right? I mean, we know with the COVID environment, right, and exchange rate, and I think we want to continue to watch how things unfold, and we'll see obviously in next quarter if there is a need to revise, but I think it's a good indication at this point in time.
Right. Thank you so much.
Thanks for joining us.
Thank you. The next question is...
Yeah, one probably last question.
Sure, sir. The next question is from the line of Vishnu Kumar from Spark Capital. Please go ahead.
Very good evening, sir. The first question is on the Brazilian currency and the margins. Now, the current currency range is even worse than what it was in 2Q. And just if you could highlight us, how should we see the margin profile from this region going forward? Is there some hedges that have got rolled off, or we should continue to see that the base margins in this region should at least be maintained?
Diego, you want to answer this?
Yes. Yeah. So I mean, as we said before, we are we see prices in local currency. We are increasing prices in local currency, and the trend is in line with what we were planning. There is always a lag, right? When you get such a very strong impact in one quarter, like we saw in Brazil, and subsequent, a couple of lower, but nevertheless, the devaluations after that. What you start doing is you start adjusting your price list, right? You send new price lists, but then there is, your customers have stock in the channel, so it takes a certain time, let's say, to bring prices up to the level they were before. But historically, we have shown that margins over time are robust, and we feel well about our ability to get there. At the same time, what we have an immense amount of new product launches in Brazil. That's, I think, the good news is that we have a tremendous pipeline that is bringing more and more products that are higher in margin, and that will help also our mix over time. So I think that is a statement that I think applies not only to Brazil, but overall for UPL. I mean, our pipeline is very filled, and the target and the focus of the entire team is on increasing the share of revenues that we do with what we call higher value brands, right? And there is even an incentive program that awards sales reps that are actually pushing to sell those products. So let's say that from the standpoint of our ability to recover in the short term, the effects of the devaluation, but also in the mid to long term, our ability to push the right mix, I feel confident that we can see margin expansion over time.
Got it, sir. And the second question is on Mancozeb. Circling back to the previous one of the earlier callers that had also asked, what would be the current proportion of Mancozeb on the combined portfolio in terms of percentage, if you could roughly give us a number?
I don't know that I have the number on the tip of my head, but it's small, call it. I mean, the good thing about our business is that no product makes more than a single-digit percentage, let's say, in our revenues, and also the same applies to customers. Even more applies to customers and to crops and to let's say crop product combination. So it's very, very diversified, and call it overall Mancozeb is going to continue to grow as a product despite some threats of regulatory pressures in the one or the other country. Overall, the trend for Mancozeb is positive, even in the worst case scenario, right? Because we have launched Mancozeb in many crops, in many formulations. So again, no big dependency on Mancozeb. Nevertheless, actually, Mancozeb is a tailwind for us in the coming years.
Got it, sir.
And also, UPL has a complete portfolio of technologies. Today, even if there is some pressure, we have technologies which will replace that. So we believe that we will continue to keep the market share we have with our portfolio of technologies for farmers to meet this challenge of what they are facing if there is a regulatory pressure. So we've known this and we continuously evolve our strategies based on the changes in the regulatory environment, and we keep investing, over-investing sometimes in terms of having options to replace certain portfolios in case there is.
Sorry to interrupt, Mr. Shroff. So we're not able to hear you clearly.
Okay. Just saying, is it better now? Basically, we have a portfolio of technologies which can, if there is any pressure on any particular market, we have a portfolio of technologies which can replace that. And we've been working on that for a while, and so we believe that we will be able to continue to keep our market share in any case And so we are quite comfortable with the situation that doesn't cause any material impact in the long term to our revenues.
Understood, sir. Just a question on this again. Will propineb be a replacement for mancozeb or is it not?
Sorry, what? Sorry. What was the question?
Repeat your question.
Will propineb be a replacement for mancozeb or that's something that will not be?
Propineb is the same chemistry, exactly the same chemistry. Yeah. It's a sister product. So there are many other replacement technologies. We'll share with you at the appropriate time.
Got it, sir. And just one final, if I can squeeze in, just a volume, price, and FX mix. That's all.
Yeah, that I think we have shared in our presentation, and I'll just repeat it for you. For the first half, our volume growth was 10%, and price we had a -1%, and FX was -2%. So that's for the first half numbers. For the quarter, in case you wanted to, that's for the first half numbers, right?
If you can share it for the quarter as well.
Yeah, quarter we had a robust growth of 21% in volume. We had a -12% in price, and FX was about -4%.
Got it, sir. Thank you and all the best.
Thank you very much, Vishnu, for joining us.
Thank you. The next question is from the line of Surya Patra from PhillipCapital. Please go ahead.
Yeah, thanks for this opportunity, sir, and congrats on a good set of numbers. So having successfully integrated Arysta now for more than a year now, now you have started integrating the supply chain activities. So is it possible to say by now what is the level of integration for Arysta's requirement is now integrated with the current manufacturing activity what UPL is having, and what is likely that it can see in the following year or next year?
Thanks. Diego. So basically, this is an ongoing process. A lot of our investment in rationalizing our, Arysta had a very asset-like business model. So we are commissioning some plants for manufacturing. Those all are being commissioned within this period of time, within the next, currently in the next 18 months. We will see a lot of cost value capture in some of the manufacturing facilities. So that is an ongoing process. Also, because we are getting more competitive, volumes are growing and we are able to continue to gain market share and keep our market share on those products. We also, where there was a lot of toll manufacturing, we have excellent relationships with so many manufacturing companies in India and all over the world. And we are helping them improve their technology to reduce costs. So even the existing toll manufacturers have been able to reduce costs, and we've been able to help them to improve the cost position, and all these benefits will continue to come.
Sure. My second question, sir, on the Diego, if you can just mention about your achievement in terms of your new product launches or even differentiation, what you mentioned in the presentation. So what is your achievement so far, and what is your milestones on this front, let's say in the current financial year, or the milestone timeline you can mention?
Yeah. So, and we will certainly give you a more detailed update on our pipeline in a future investor event. But we are very excited with the pipeline, and not only the pipeline in terms of the future prospects, but actually how we are tracking with the launch of new products this year and last year. We have a innovation rate that is north of 20%. I'm talking about products that we have launched in the last 4 years. And our target is to continue to increase that innovation rate over time. I would say our problem right now is not the lack of projects. It's really that we want to execute this fast, and we want to execute these projects cost effectively. But we have, across herbicides, insecticides, fungicides, biosolutions, a very, very filled pipeline. And in some cases, clear gaps in our portfolio, but despite the large portfolio of now the combined companies, we have products that will fill some remaining gaps. Like, for example, I was talking about soybean fungicides in Brazil. We are going to participate largely in that segment, and we are launching the first product in the fourth quarter of this year. But we have multiple launches in Europe that are not only biosolutions that are being demanded more and more, but also to fill the gaps of some products from competitors that are leaving the market, right? And so we are repositioning several of our portfolio products there. And very, very interesting also is in India. The growth that we're getting with new products. If you look at our business today in India, and you look at our business 5 years back in India, it has changed significantly because of the amount of new technology and product launches. So the ability that UPL has in not only be cost competitive and strong in the post-patent business, but also to play in the innovator space, I think is unique in the industry, and it's a result of the combination of the competencies, from Legacy UPL and Legacy Arista.
Okay.
But we will be giving you more details. I think we will have an investor day certainly sometime in the future where we will show you more meat to the bones to the pipeline, and happy to share this with you also.
Thanks, Diego. Just last one question answer. If you can just tell me that the kind of sequential weakness in the gross margin that we are seeing, what portion of that is just because of the currency devaluation?
I think the vast majority is that. Go ahead, Anand. Maybe you have.
No, go ahead, Diego. Please go ahead.
Yeah, I think you can see it in a way when you look at the price and exchange rate effect that we show in the deck. You can see how much is competitive pressure and how much is exchange rate, and the vast majority is exchange rate very clearly.
Sure. Okay. Yeah. Thank you, sir. Thanks a lot. Wish you all the best.
Yeah. Maybe a last question. We'll take one more and then we call it a day. Go ahead.
Yeah. Ladies and gentlemen, we'll be taking the last question. That is from the line of Matthias Vammalle from Blue Bay Asset Management. Please go ahead.
Hi, Anand and team. Thank you for the call and the question. I was wondering, and being mindful of time, happy then to otherwise pick it up and take it up offline, Anand. But I was wanting to get a bit more color on the deleveraging. It seems net debt is actually unfortunately a bit up this quarter and quarter the first half of the year. So I was just wondering if you can help me understand a bit of the changes in this quarter, this year, this first half, and then how you're going to reconcile that with managing to land it a bit lower for the end of the year. And in line with that, if you can just tell us how much for the receivable sales for this second quarter and or the full first half. Thank you.
Thanks, Matthias, for joining us. As always, great to talk with you. So, Matthias, if you because of the seasonality of our business, typically Q1, Q2, Q3, until Q3, you will see the working capital going up, and then we see a sharp drop in Q4. This has been consistent over the last, I would say, 7 to 10 years. And even after the acquisition, the trend remains the same because we're in the same line of business. What you should be, if you see, our working capital has actually gone up by about close to 400 million, but our net debt has gone up not that much because we generated good cash in the first half. But as I said, Q3 you will see some further net debt going up, and then a sharp drop. Last year in the same quarter, last year in Q4, we almost reduced our net debt by almost $1 billion, slightly more than that. So that's the nature of the business, and we remain committed to be at net debt to EBITDA of 2x, which is our commitment to all the rating agencies, and that's something which we are on track. So that's something which we are looking forward to delivering as of 31st March 2021. So that, and on the receivables discounting as of 30th of September, from March year end, if you recollect, we had about 970 million of receivables non-recourse discounted. That's now numbers dropped to about 500. Typically it peaks in Q4 because a large part of Europe and US receivables get discounted on non-recourse basis, including that of Latin America and some of the countries.
Thanks. Sorry, two questions. How much you said was outstanding at September? Sorry,
500 million.
Okay, perfect. And then perhaps the last question is you're holding partly because of the recent issuance and the tender transaction, you ended up with a net higher amount of cash, so you're holding about $1 billion in cash. What we have seen in some other companies, and